welcome back. In this module, we are going to talk about adjusting journal entries. So in the last module, we did regular journal entries. These are adjusting journal entries. So think of it like this. Regular journal entries reflect our business transactions, our external business transactions, right? Usually there's another party or person involved. So if we buy something, there's someone out there that knows that we bought it. We exchanged cash, or we exchanged accounts payable and accounts receivable. If we receive cash, someone else, basically anytime we use cash, there's someone else involved, right? Because we don't pay cash to ourselves. So we either pay cash to someone or we get cash from someone. Our adjusting journal entries are internal transactions. They're things that really only we know about, and we're basically just doing it to keep our own books clean. So think of it like this. I go to Raley's and I buy a 1 pound bag of almonds, okay? The external transaction is when I go to Raley's and I gave them, I don't know, $8, and they gave me this pound bag of almonds, and that was our business transaction, okay? I debited almond inventory and I credited cash. Now internally, maybe I want to track how quickly I'm using up the almonds or how many I have left. So my adjusting journal entry, my internal transaction would be every time I take a handful of almonds, I would debit eating expense and credit my almond inventory, okay? But Raley's doesn't care. They don't care how quickly or slowly I eat them. Their part of it's done. They got their cash, they gave me the almonds, they don't care. But I care. I want to track how many almonds I eat. Every time I eat some of these almonds, I want to track that so I can look at my balance sheet and see how many almonds I have left, and I can look at my income statement and see how many almonds I've eaten, okay? That's kind of a simplistic version. So let me tell you a couple rules. These are written down too. You can read it, you can watch the video, you can do both. That way you hear it twice. All right, so remember way back in the first module, we talked about the rules of the game, and we talked about our principles, constraints, and assumptions. Okay, so the two principles that are going to come into play, the reason we do our adjusting journal entries, are revenue recognition. Remember, revenue recognition principles said that we recognize revenue when it's earned. And so if we haven't earned the revenue, then we can't recognize it. So if you pay me today to mow your lawn next week, I can't recognize that revenue till I actually go mow your lawn, because before that I haven't earned it. And then we have our matching or expense recognition principle, which basically says that the expenses related to the revenue should be recorded in the same period as that revenue. So if you pay me today, I'm going to mow your lawn next week, and I have to go out and buy gas, I'm not going to expense that gas until I actually mow the lawn, because that's when I record the revenue. So all of the expenses related to earning that revenue for mowing your lawn, those come in when I actually record the revenue. Okay, so, and we're going to go through this, but I'm just trying to give you an overview. But there's some things I want you to know, and this should have an N in it. Adjusting journal entries. Write these down. Again, don't memorize them. That's not a good use of your brain space, but write them down, have them handy, because they're really going to dictate why we're doing this, and it'll help you make some good decisions when you start getting to homeworks and quizzes and exams. All right? Good deal. All right. So the purpose is to record revenue and expenses in the correct period. So going back to my almonds, I'm not going to record almond expense when I pay Raley's. I'm going to record it over time when I actually eat these almonds. It's going to take me a while to get through a pound of almonds, okay? So if I just counted on the external business transaction, the regular journal entry, I'm not going to get my revenue and expense in the same period. And the revenue recognition and matching principles say that I got to get those revenue and expenses in the right period, okay? So that's the purpose, to record revenue and expenses in the correct period. This you should definitely write down. Adjusting journal entries always impact one income statement account and one balance sheet account. So every adjusting journal entry is going to impact either revenue or expense from the income statement and either asset or liabilities, okay? So make sure every time you book an adjusting journal entry that you've impacted one income statement account, revenue or expense, and one balance sheet account, asset or liability, okay? They never impact cash. Adjusting journal entries never impact cash. Remember, this is our internal accounting. If I've exchanged cash with someone, that's external, right? Because I don't pay myself cash. That would be really a waste of time, okay? So our adjusting journal entries will never impact cash. If you have this list handy and you go and you prepare your adjusting journal entry and you go through your checklist and you go, ooh, I touched cash, you know that's wrong because you never impact cash with your adjusting journal entries, okay? And they're generally booked on the last day of the period. So during the month, say, we're going to go through and book all of our external transactions, right? I'm going to actually debit almonds, credit cash, Rayleigh's going to do whatever they do with it, and we're just going to do our day-to-day stuff. Then when we get to the end of the month, we're going to say, hey, what do we need to adjust? And we'll say, well, we ate half a bag of almonds, so we need to expense 8 ounces of almonds and decrease our almond inventory by 8 ounces, debit and expense, credit a asset, almond inventory, right? One income statement account expense, one balance sheet account asset. And we generally just do that on the last day of the period, just because we can knock through it, and it's a lot easier than trying to keep track through the month of what we did or didn't do, right? I don't necessarily want to, every day when I eat 5 almonds, book that journal entry. I'm just going to go to the end of the month, see how many I've eaten, and record it. All right, and they're internal. We talked about that. So these are internal entries. Nobody else necessarily has visibility. Rayleigh's doesn't know I'm doing this. They don't care. Okay, so this is really just for us to keep our books correct and compliant with the revenue recognition principle and the matching or expense recognition principle. All right, you ready to get started? Let's jump in.